Today we're talking about 5 financial terms you need to know to make and keep more money. Here we go. Welcome back to REI Simplified. I'm your host, Adam Johnson, where we break down complex real estate situations and scenarios for people like me and you, the beginning investors. If you haven't already, please like and subscribe, share with a buddy. Why not? It's free. It really helps the algorithm, helps us get in front of more people. Today we're talking about 5 basic financial terms you need to know whether you're in business or just sitting at home working a job. Does not matter. These are things that I wish I had known before I was 32 years old. I subscribe to the Rich Dad Poor Dad simplicity when it comes to understanding these terms. You can look in Webster Dictionary. You may find a little bit different terminology, but I'm gonna give you, like I said, what Rich Dad Poor Dad, the way he breaks it down and makes it very simplistic, and it really helps us. I hope it helps you as well, but because of the simplicity, we're able to understand these terms, use them in our business, and therefore we're much more profitable than had we not known what we're doing right now. So the first thing I'm gonna talk about today is what is an asset, okay? And the way Rich Dad breaks it down is an asset is something that makes you money. Simple as that. If it does not make you money, it's not an asset. So the big question in his book is your personal home an asset? And the answer is no, because that home does not make you any money. Yes, it may be appreciating. It may down the road when you sell it make you money. But right now, today, when you pay that mortgage, that is a liability. That is not making you any money. A counter argument to that will be a bank statement, a balance sheet. With a balance sheet and with a banker, they're going to tell you when you go for a loan to list your assets and liabilities. A bank and your CPA are usually going to list your personal residence, your personal vehicle, and things like that as an asset. And like I said before, that is not an asset when it comes to money. Let the bank list that for you. If it helps you get a loan, great. But for your numbers' sake, for your monthly your balance or your monthly cash flow and all that kind of stuff, it's not making you money. So once again, an asset makes you money. Are your children an asset? No, they're not. Kids cost you money. So an asset makes you money. Rental real estate are all my assets. They make us money every single month. My truck, not an asset. My house, not an asset. Those are things that are costing me money. The next thing is we're going to talk about is a liability, which is the opposite of an asset. A liability simply costs you money. Simple as that. So children, your personal residence, that gym membership, whatever is taking money out of your pocket, that's a liability. Simple as that. So don't overthink things. Don't overcomplicate. An asset makes you money. A liability costs you money. I don't care where it goes on your balance sheet for the banker or your CPA. In reality, asset gives you money. Liability takes your money. All right. The next big term we're going to talk about is cash flow, which is simply the flow of money coming into your business, into your checking account, out of your business, out of your checking account, whether it be from your rental properties paying you, your boss paying you, that's all income. And then your expenses are your bills and stuff like that. Now, what we call positive cash flow is when the income still has a little bit left over in your checking account or bank account after the expenses are paid out. So if I have $10,000 of income from rental properties and I pay out $8,000 to expenses, mortgage, repairs, so on and so forth, I have a $2,000 positive cash flow. So cash flow is the most important thing. When I invest for cash flow only. When I buy a property as a rental, I'm buying it for the cash flow that's going to produce us right now, not for the appreciation that it may or may not have down the road. So I invest for cash flow primarily. If I can sell the house down the road, that's a bonus. But that's not what we're in business for. I mean, cash flow is my way of life. The next thing I want to talk about is appreciation. All right. Something you need to know about with your assets. Your assets, even your personal residence, appreciation is when the value of something goes up. All right. Simple as that. 9 times out of 10, a home, a residence, a building, a structure, land will almost always appreciate. It almost always go up in value. Not every time, but As I said before, when I invest, I do not invest primarily for appreciation, for the asset to go up in value. I invest for what the asset can do for me today, for next month, next 3 months, next 5 years in positive monthly cash flow. So appreciation is beautiful when it happens, but don't bank on appreciation. The next term is depreciation, or the opposite of appreciation. Usually when you hear the term depreciation, it's talking about real estate, it's talking about the asset depreciating yearly for tax purposes. Now, I can't explain why, but this is what depreciation means to me. The IRS says that a structure will be worth nothing in 27 and a half years. I don't know why 27 and a half years, but here's how this looks. If I have an asset that's worth $200,000, I will take $200,000, divide that by 27.5 or 27 and a half years. That number is going to be, I don't know, $7,000 or $8,000 a month. I hope that's right, or close. The IRS will then give me a $7,000. I'm sorry, let me backtrack. If I have an asset worth $200,000 and it will depreciate to zero in 27 and a half years, that may be a $7,000 or $8,000 a year, not per month loss on paper. So if I'm losing $7,000 a year by depreciation, but the asset rental brings me $5,000 a year in positive cash flow, I still lose money on paper because the asset has depreciated that year more than the money I brought in. That's a unique way to be able to legally shelter or not pay money for taxes on that income. Talk to your CPA about that. I'm not a CPA. So depreciation is the property value, the asset losing value over time. However, in reality, the property value is going up. I'm not sure why the IRS does that. I think it's their way of incentivizing people to invest in real estate. All right, so those are the main ones. The last one I'm gonna talk about is equity. What is equity? Equity is the difference on what an asset is worth versus what is owed on that asset. It can be a vehicle, it can be a property. I always use real estate. If I own a property worth $200,000, but I only owe $150,000, I have $50,000 of equity. Simple as that. Equity is very important when it comes to flipping houses. Like I said before, I don't look for equity when I look for buying rental properties. Those are buying, hold, long-term investments. If I'm flipping a house, I have to have equity because I'm going to flip it, sell it fast. If there's no equity, it's not a flip house. So you have to have, within our business, we have certain criteria that we look for immediately before we decide to flip a house or not, and equity being a primary metric that we're looking at when we're checking out the numbers for those properties. So those are the main ones I'll talk about today, which was asset, liability, cash flow, appreciation, depreciation. I threw a bonus in there of equity. Those are super important no matter what you do, whether it be in real estate, you flip cars, you have a hair salon. Those are super important terms. So I hope you got something out of this, guys. As always, my name is Adam Johnson, the president of Johnson Property Investments and the creator of REI Simplified. If I can help any of you guys, shoot me a message. Please like and subscribe, share with a buddy. Why not? It's free. Until the next video, it's been fun. See you guys later.